Good afternoon, everyone. So moving on from Bitcoin into something a little less exotic, I think, to the most of us, we're going to be talking about stablecoins. And I think it's fair to say that stablecoins have really been the talk of the time, particularly over the last year or so. And maybe more than any other topic in digital assets has kicked the door in for a lot of TradFi institutions, banks, and so on to really start looking at this overall field. Certainly that's been true for my own bank, Dankse Bank here. This is not least because of the very impressive numbers that stablecoins are putting through right now. If we look at last year, stablecoins accounted for more than $30 trillion worth of volume, depending on how you measure, to be fair. And there is unprecedented levels of investment right now going into the stablecoin field. New stablecoin issuers popping up everywhere. There are companies in the hundreds building across the whole stack of services related to stablecoins, whether that's in distribution or orchestration or whatever it is. And I think a lot of industry observers right now really believe that stablecoins is sort of on the cusp of going from being a very crypto-specific thing and really becoming a part of the fundamental plumbing of our financial services. So that is what we are here to talk about today, and have an excellent panel with me. Guys, please go ahead and introduce yourself and explain a little about why you're here and what your angle on stablecoins is. Let's start with you, Emma.
Hello there. My name is Emma Lovett, and I work on the Markets Digital Assets team at JP Morgan. So we actually sit within markets, within trading, reporting up to the head of trading, looking at how we can introduce DLT blockchain technology in general to make markets products more efficient. On the stablecoin side, obviously I would be looking at it more as a user and as something that our clients will want to use, as opposed to the payments team, which would be sort of like looking at it from the payment side.
Hi there, my name is Simon. I'm CFO and CPO of AllUnity, and we are the first German issuer of regulated stablecoins. And besides our already live Euro stablecoins, we just announced that we will also launch a Swiss franc-based stablecoin soon.
Yeah, thanks, Simon. My name is Rens Groot. I'm Chief Commercial Officer Europe for Zerohash. We at Zerohash, we provide the blockchain infrastructure to banks, brokerages and other interested parties. And before that, for a brief period, I was a prop trading supervisor with the AFM and spent the better part of my career in the dealing room of ABN AMRO trading FX and derivatives.
I'm Elliot Hentov. I'm in charge of macro policy research at State Street, the asset management arm. I'm very much representing TradFi on this panel. You can see I'm even wearing a tie. I just came from a pensions trustee event where the last question was on blockchain, but everything else was far removed from that. I'm here because we launched a digital research stream 5 years ago where we looked specifically, starting with stablecoins, at how blockchain is changing the financial architecture, kind of long-term, big picture thinking. You know, how does technological change impact how capital markets operate, how capital flows, how it gets deposited and stored. I also have a second hat where I sit on the advisory board for Stablecoin Standard, which is the industry association for stablecoins globally.
I'm Anthony Georgiades, run Innovating Capital. We're a technology infrastructure-focused fund based in New York. We're involved in stablecoins really from the standpoint of we view them as primitives, not necessarily products. And so a lot of our investments are really more focused on the layer that stablecoins are built on, the layer that sits below, whether that's scaling tools that allow for cross-chain transactions, things like that. Speaking of the TradFi world, a few of our largest investors work at very large banks, and one of the biggest issues they have is they don't even necessarily fully grasp that stablecoins can be denominated and issued on this concept of more than one blockchain. There's another blockchain out there besides Bitcoin. There's a stablecoin on Ethereum or a stablecoin on Solana or things like that. So a lot of what we're invested in is how do we abstract that sort of weird layer away so that we can actually bring stablecoins into a lot of the traditional systems that we're focused on now.
Thank you very much, guys. And for good measure, I'm Clemmensen. I also represent TradFi here. Unlike Elliot, I didn't bring a suit. I do have a suit on my picture up there. It's probably the only one you can find anywhere. It's from my wedding, that's why. Anyway, so to kick this off, I would actually go straight to the question posed in the title here. Are stablecoins becoming a money market competitor? For those that don't know what money markets are, these are the markets in short-term debt instruments like treasuries or other cash-like financial instruments. They primarily serve the purpose of being the mechanism to provide financial institutions and others with sort of short-term funding and liquidity mechanisms, right? I think maybe it might not be entirely the right question to ask here, though. Certainly, in my opinion, stablecoins are not today, at least competing with these assets. They are rather sort of becoming an integrated part of this wider financial architecture, if you will. Maybe, Elliot, could you start with you there? Is that how you see this too? Is this a question of competition or more integration?
Yeah, I don't want to cut this panel short because the answer is no. But obviously there's more to talk about than just saying that. The reality is that the confusion is somewhat justified. And again, when we first looked at stablecoins many years ago, pre-regulation, pre-everything, we thought, well, how will the regulators look at it? And the regulators look at it like a money market fund. And if you think about the Genius Act and everything else, it's very much a little bit copy-paste from the money market fund regulation. But from a systemic point of view, of course, these are two very different instruments, different channels. One is a savings investments vehicle, the other one is a payments method. But obviously, the back door, and obviously with Simon's here representing a stablecoin itself, looks quite similar. The collateral that makes up the other side, the asset side of the stablecoin, looks very much like a money market fund. I would just caution that there is still a slight debate, and it's out there. If you think about the number one issue the American Banking Association in 2025 has spoken to US government officials about was stablecoin yields, stablecoin rewards. The number one issue American banks spoke to regulators about last year. And because theoretically, if stablecoins were that portable money market fund, the fund you just leave your cash sitting, you get interest, and at the same time you could do payments and transfers and cross-border payment, all that, then of course that would be a competition. But clearly the regulators don't want that to happen, and I don't think it will.
All right. Let's get back to the question of yield. It's an interesting one in a moment. But then, so having now answered the question we were posed here, let's then move on to talk about, well, what are stablecoins actually being used for and what are they actually competing with then? So we have a couple of different perspectives here. Maybe Anthony, you want to start here in sort of the VC perspective. How do you see this? There's, as I mentioned, a lot of investments going into stablecoin companies and infrastructure at the moment. What's it going to? What are they building towards?
Yeah, I mean, listen, there's no doubt that the early product market fit that stablecoins have really, been predicated on has been trading, degenning into obviously a variety of different liquidity sources, yields, etc. And they are more akin to, money market vehicles in that respect. But over the long term, the general construct, and if you go back to kind of what I was alluding to with some of the financial banks, is how do we layer these primitives into our existing ecosystem in a way that they really are invisible, right? They just tap into financial rails. They just tap in across multiple different types of blockchains across the ecosystem in an interoperable fashion. It's super easy to pay contractors, pay employees. It's super easy to have a cross-border remittance that settles in real time. And so a lot of the investment in terms of where VCs are focused, it's really siphoned into two. There's still a lot of investment that's going into new emerging stable coins, denominated in different foreign currencies and whatnot. Those are really more or less judged on total value locked and potential sources for yield. But where a lot of the meaningful investment is going to right now is really that sort of invisible layer of back-end infrastructure. Things like orchestration, right? Who decides in an autonomous fashion when to potentially use stablecoins and when not? And how do I bridge stablecoins across different ecosystems? So it's very much so focused on the back-end rails, and we're still seeing a lot of money go into that. When that really starts to hit the market, and when people stop stop talking about stablecoins, but we obviously know that they're being used, that's when we've obviously known we found the true product market fit that a lot of us are looking for.
Great. So, Simon, you represent a stablecoin issuer here in AllUnity. What are you guys going after? I mean, we all know that today, stablecoins, the volume that they have, impressive as it might be, it's still 90% where it started, right? It's in the crypto trading markets and in the integration into the DeFi ecosystems, right? That's probably still 90% of the volume today. I don't think that's what you're building towards, is it?
So, I mean, this market is driven by something that's actually pretty close also, or even, could say, better or worse than money market funds. I mean, the yield that an unregulated stablecoin pays if you stake it, it's actually not staking, it's just getting paid, in a DeFi protocol is insane. People receive 20% interest. That cannot work. I think whether you have worked, as I did as well, in a TradFi company or not, I mean, you understand that this is not a healthy mechanism, then that it simply doesn't work. Why does it work, by the way, for the unregulated stablecoin issuers? Because they mix other stuff besides money market instruments in the portfolios of their so-called backing. And in a bullish market, that creates yield that's even higher, and so they're able to spread that yield via incentives to the protocols, and the protocols spread it via credits to the DeFi world, to the clients or the holders. So that's an unregulated market with unregulated instruments that pays something that is not very healthy. Works short time, doesn't work long time, and we'll especially see that now with a bear market that we're tapping into, how this might develop mid to long term. That is why we're not doing that, because we are a regulated stablecoin. So for sure, we cannot even close to compete against the unregulated stablecoins when providing a DeFi credit yield. Yeah, it's impossible. Why? Because actually our backbone structure is much closer, indeed, from the reserves perspective to a money market fund, which means our yield is much lower. So we are not even able to pay sustainably yield as other unregulated stablecoins do. But that's also not our purpose. Our purpose is to provide cheap, efficient payments. And that's what we are focusing on. So right now, if you are a Euro stablecoin issuer and you want to have big volumes, it's easy. It's like supermarket. You can buy it. The price is just pretty high. Yeah? It's much higher than what you receive as yield as well if you have a conservative reserve management. And for that reason, getting a big TVL is not an achievement, it's just the pockets. Anybody who tells you something else is lying. That's just the reality of the European stablecoin market. For anybody who wants to involve or get involved, if you want to have volume, prepare for deep pockets, because guess what? Crypto trading happens internationally still heavily based on US dollar. Also, European traders don't trade Bitcoin against Euro, they trade Bitcoin against US dollar because it's a global market that is basically always comparing against US dollar. And so, this is not our playground. This is not what we do or why I do my job. I don't want to do my job to provide 21% yield unregulated in a DeFi protocol. I want to make efficient payment mechanisms available to people, and you just mentioned that also with the invisible layer. I mean, we are talking now to large grocery stores, for example. How can we embed probably stablecoin payments in the background for both sides? Their clients, but also for the distribution partners that actually provide them with products internationally as well. Yeah? How can we even for financial products and financial services embed stablecoins in the background to an extent that the client even doesn't notice it? Yeah? Because we can guarantee that an actual transfer of regulated money, it's a regulated euro, can happen in seconds from Europe to the US, for example. And if I, as a small company, want to send right now money to a provider that comes from the US, I pay $50 US and I wait 2 days. That we can solve.
All right. So what I heard here was payments, is the short version?
Correct.
Maybe, Emma, you look like you wanted to say something here. Do you agree with that? Are we going in that direction? And will stablecoins ever become truly a global infrastructure for payments?
So I think, yes. So I think that we've almost got sort of the crypto world that's going on over here, and that has been reasonably well established, especially on the retail side. And then we've got TradFi sort of here on the left. And that sort of, been using these existing rails for a long time. Now, when you start to look at this middle ground in the middle and start to think about how some of those more traditional securities might move onto these distributed ledger technology rails, it brings up the whole concept of payments and what digital payments are going to be used. For all my career in banking to date, I've never had to really think about the payment side. A trade was always delivery versus payment, and nobody really thought about the cash side of it. It was more around analysing the risk of the security and whether or not you wanted to buy and sell that security and when. And now we're starting to think about, if we're going to be using distributed ledger technology rails, what will be the payment mechanism for that? And when we were, when most of the active products on distributed ledger technology were on privately permissioned blockchain platforms, they often had their own sort of very bespoke payment mechanisms, whether it was a blockchain deposit account or the trigger solution, or even the payment actually never taking place on DLT. The payment would take place free of payment, completely away from the security that was on DLT. And now we're starting to think a bit more ambitiously with the use of public blockchain. And I think we have got to think, especially in the short term, about how our clients are going to want to use stablecoins. And I think that will lie really in the payment side of things. If you've got a $500 million US dollar denominated bond, say, at new issuance, is it conceivable that investors are going to want to use whichever stablecoin they want to choose, because it's still, in their eyes, dollar denominated, and use that stable coin that they will choose whichever preference they want to use at that time for the payment for that traditional security, that bond. We're not there yet, but I do wonder if that's sort of the path that investors are going to want to take, particularly with Fidelity Digital Assets announcing their own stable coin yesterday. Is this the landscape that the investor, that the buy side see transforming their side of the industry over the next 2 to 3 years?
Yeah, thank you. So in other words, settlement. So we have payments and settlement going on here, which I very much agree with, by the way. And for those who don't know, Danske Bank also is part of another Euro stablecoin issuer. And I can tell you that definitely the payments and settlement use cases are the ones we think is the future for stablecoins beyond what they are already used for. Rens, maybe to give you the chance too. So you're out there providing infrastructure for banks and others to actually handle these assets. So what are you seeing
that's
them
correct.
do? Yeah.
Yeah, so first of all, we would love to see some more euro-denominated stablecoins, but that's for you guys to fix. And to take it a bit more practical, we as Zerohash, we speak to a lot of platform operators, banks, etc. But we also love to speak to the end customers, and the end customers that provide us with real-life use cases. And very recently, I spoke to a CEO of a payment company, and together we visited an end customer who at that moment had a container full of tropical fruit stuck somewhere in a port in Africa, waiting for the payment to come in. The payment was supposed to come in via the SWIFT network, but it was not there yet, so the fruit was turning bad. And he said to me, look, Rens, or look, Zerohash, or whatever, I'm not interested in blockchain, not interested in blockchain technology. I'm interested in my container containing tropical fruit. How are you going to solve that for me? So, in fact, he's interested in the speed of blockchain, the speed of stablecoins. So I think that's a real use case, especially on a location, let's say in Asia or Africa. We can really add value there with stablecoins. And moreover, the costs are way lower, of course, like already being said, but also when payments get stuck in, let's say, the SWIFT network, you need to get an investigation going. So you need to call your bank, you need to get people moving, you have to pay costs for that. People that start finding capital that already belonged to you in the first place. and they will find it, let's say, in a week or in 2 weeks. But with stablecoins, end clients can just log into a public block viewer and see where their cash is. And it's very simple. It's at the initiator or at the receiving end. It cannot be anywhere else. So the verification of block viewers is also a very, I think, a good point for stablecoins. And besides that, I think when you go through the SWIFT network, when your payment goes to 1, 2, 3, 4, 5 correspondent banks, in the end, there's no way of telling which amount will actually arrive in the African port. And I've been there, I've sold SWIFT solutions in the past, and that gives rise to, well, discussions with clients that you don't necessarily want to have. So I think there are a lot of real-life use cases for the stablecoins that we're speaking about today.
All right. So again, we're talking about transactional activities here again, not
Trade finance.
Indeed. So I guess that's sort of the takeaway here on this question. These stablecoins are really moving towards becoming transactional assets that do things more efficiently. They can do them 24/7. They can do them in a more transparent manner, as you say, Rens, and so on. So again, not really things that we're thinking about when we're talking about money markets. But one thing where there definitely is a big overlap between these two things is, of course, on the underlying assets. So stablecoin issuers are emerging right now as some of the biggest allocators actually into money markets. So they are, of course, investing a lot of their reserves into things like treasuries. I believe Tether right now by themselves hold more treasuries than many large countries do, for instance. Elliot, I believe this is something that you and the good folks at State Street have looked quite a bit into, these macro implications, as you call them. If we imagine a world where stablecoins continue to grow, many are predicting that we will have trillions, potentially tens of trillions of stablecoin supply within the next 5 to 10 years. What does that mean, sort of, from a macro perspective? What kind of impact will that have on our more, grand financial architecture and capital flows and so on?
Yeah, I gave that anecdote before that the American banks were panicked, or still panicked, about stablecoins offering yield, because in the domestic context, obviously if you have yield generation, if you can earn money on your savings, then what's the point of keeping them in a bank deposit? And money would wander off, and that would have huge systemic implications. Now that's not going to happen, or that's not, I think most of us on the panel here probably think that that's not going to happen. But that is going to happen in non-dollar areas of the world, where holding the dollar on its own has a variety of benefits and attractions. And so there you are going to get a hollowing out of the banking sectors, or an erosion of the banking base. So that's one major problem. And then the second major problem is, of course, that you have the FX dimension. You basically you'll have money being converted from local currency into US dollars. And if that happens at large scales, that's a problem. Then what does the country do? Either it tolerates kind of its loss of monetary autonomy, basically it gets dollarized against its will, or it allows higher inflation, it allows its currency to tank, or it imposes capital controls, which of course is hard. These are not great options. Either way, this is very destabilizing and fundamentally a problem, which is why I think a lot of countries, both developed and emerging, are going to respond. In the developed world, they're going to respond by hopefully promoting their own stablecoins. Emma just mentioned, like the holy grail of all of this, of the settlement currency, in my view, as a capital markets participant, is capital markets. The idea that we have, an equity market that's 100 trillion, we have a bond market of similar size. You tokenize some of that, you need a settlement currency, and that's the real mass adoption. Emma gave the example. Well, what do you do if the only option is dollar-based? Well, that adds an FX risk, that adds an operational complexity to everything. So I think developed countries are going to respond by, I do think, eventually seeing the light. I know that the UK is actually thinking quite seriously about revamping the stablecoin framework here. And also an alternative settlement currency in terms of central banks. For emerging markets, it's a much more bigger problem, because there the choice is, it's not as easy just to promote your own stablecoin.
Thank you. So a couple of things perhaps to dive into a little deeper here. You mentioned first of this deposit-based risk that the banks are potentially facing. This has been a discourse for years, right? It's the same with the whole debate on central bank digital currencies. The fundamental idea here being, well, if stablecoins grow very large, a lot of the money flowing into their reserves are going to come from the deposit base of banks. That in turn will hurt the bank's ability to fund the economy and provide credit, essentially, right? Something a lot of people have been talking about. I'm wondering, so you don't seem to be particularly concerned about that at State Street, it sounds like. I'm wondering if the rest of you have any different views on that? Should banks fear stablecoins? Will they be a competitor to bank deposits down the line, really?
I guess there's no major fears here. I do think banks will obviously have to evolve. As an example, I'm in the asset management arm of a major bank. We are tokenizing our other product suite. But again, tokenizing is not the same as issuing your own coin. That's a bigger debate. I think large houses, very large financial institutions have an attraction and an opportunity there to issue their own coin because they kind of have the scale that comes with it. But I don't think that'll be an option for smaller houses.
That's right. And at JP Morgan, on the payment side, they certainly see the deposit token. So they launched JP Morgan Coin in November last year. And they see that as being largely the use case for institutional payment. And stable coins being something that is more focused on the retail side. Now in markets, I'm yet to see whether, I'm yet to see, which use case on the institutional side is what's chosen. But the payment side certainly see that their deposit token is going to be something that's used institutionally to institution.
Right. So we'll get to you now, I think, Simon. The other thing you mentioned, Elliot, was we've got this more kind of geopolitical perspective, really. And I think stablecoins are truly becoming a big topic in geopolitics these days. You mentioned this potential dollarization, essentially, in particular in emerging economies and the like, where people are using stablecoins as a store of value. But even in places like the EU, and here in the UK, I suppose, there is increasing discourse from the policymakers and central banks, and really a growing fear what this, digital dollarization, as they call it, represents, right? Because what they are, in essence, fearing is that once an increasing portion of the money supply is really issued and controlled by someone else, such as an American fintech that's issuing a stablecoin, then they lose sort of the mechanisms they have today for regulating their monetary supply and carrying out their monetary policy and so on. So that is also, interestingly, why stablecoins are kind of high on the strategic agenda of the US right now. The US administration is actually quite explicit about the fact that they consider them geopolitical tools to expand the reach and dominance of the dollar as the world's reserve currency. And this is turning into a whole big geopolitical debate right now. So, Simon, I know this is something that you also see as a key objective for you guys, right? Do you have something to share on that, on the importance of building stable coins in other currencies, such as the euro?
Yeah, absolutely. I think one of our goals when we started was to provide a European alternative. And I think the reason that you just mentioned, Elliot, is perfectly well pronounced, the dollarization. Actually, what is happening is the dollarization. Yeah. And it's very simple if you look at the numbers. The total stablecoin volume, if you look at it right now, it's like, I think, roughly like 170 billion, yeah? And the euro market is like 600 million, something like that, yeah? So it's a fraction of a fraction, yeah? And if you compare it to existing currency markets, the volume of the euro makes up to like 20 to 25% of the US dollar. So it's a huge difference between existing currency markets and stablecoin markets, which actually means, yes, indeed, the stablecoin is leading to a dollarization. And now Donald Trump is regulating it. And you might wonder, why is Donald Trump regulating it? And since when is Donald Trump a big fan of regulation? Yeah? I haven't noticed. Yeah? But the reason is very simple. Because the Genius Act foresees that you have to invest into short-term treasury bills of the US state. So this is a refinancing instrument of the US state. And if you look at the market of government debt, it's a very closed market. Yeah? Governments buy the debt of other governments. That's how the government debt market works pretty much. There is and this is a saturated market. So if financing becomes more expensive, it's hard to cover it via the market because the market is set. But now there's emerging a new buyers group of government debt, which is stablecoin issuers. And they are not only buying government debt, but they're buying it to a significant extent. Because Tether already in 2024 was amongst the top 15 buyers of US debt and even bigger than the state of Germany, as an example. So a new buyer group comes into a saturated market and buys your debt, it becomes significantly less expensive. So stablecoins solve the short-term liquidity problem of Donald Trump because they prevent him from going into shutdown because it makes his refinancing, he's getting debt cheaper. Yeah? And therefore, of course, he says to them, let's regulate it in a way that they have to buy even more short-term T-bills because if they are short-term, I can refinance short-term cheaper. Yeah? Especially also for his legislation. But what does it lead to? It leads to actually people in Argentina that are using the US dollar stablecoins like Tether for buying products. They basically, coming back to the money market fund analogy, are buying US debt. And what does this lead to? I mean, the local currency gets weaker, the US currency gets temporarily stronger, and then what if Tether fucks up? Yeah? Nobody cares right now because they're not regulated. And to be honest, that's scandalous. Why? In 2024, Tether, with 150 employees, made 14 billion revenues in US dollars. Profit even. Did you know how much Goldman Sachs made that year with 65,000 and the most profitable investment companies globally?
About the same?
Yeah, about the same. Yeah. And everybody's like, okay, no, it's just a fintech, that's not regulated. Tether is obviously systemically relevant, and if Tether fucks up because they also mix Bitcoin in their reserve, and Bitcoin's going down, and they cannot repay the clients, the poor people in Argentina are going to pay the bill, while the Tether people have basically helped Donald Trump to refinance cheaper. And that's a mechanism that nobody's looking at, and that is geopolitical, I think, not a development that at least we, from a European perspective, foresee as a beautiful future.
So in short, you are saying that stablecoins are becoming a mechanism whereby, well, states and governments can fund themselves, essentially. Perhaps not a bad thing to have these days when the money printers are going, as we all know. All right. Well, on the topic of Tether, now that you mentioned it and them not being regulated, they did launch, I believe, just the other day, right, USAT, sort of an alternative version of Tether, which do aim to be regulated. Any of you guys have any insights on what's going on there and why they're doing that?
If you guys want to, I can add. I took a look. At first, best marketing move ever, calling it USAT. Yeah, not USDT. I mean, obviously they use it already. Yeah, but USAT is more patriotic. I mean, for me, it's a cheap deal, to be honest. Yeah, because yes, of course, they will regulate the USAT, but the deal is that the USDT stays unregulated. Yeah, and so the USAT will lead to even more short-term government being bought because they will have to invest in US Treasury bills with a maturity up to only a year, additionally to what the USDT already does. And of course, at first, it will come into place 2028, so still some time to go. And second, if USDT stays, the question is what really changes. And is there really an incentive for the US government to really like wipe out USDT if USDT already owns like I don't know, the 12th most debt in US government. Yeah.
Right.
Yeah, I think also it's a great marketing move indeed, Simon. So congrats to them. But I'm also wondering what will be the interplay between USDT and USAT. You know, will it be like in and out of an onshore and offshore stablecoin, and what will the consequences be, etc. And to touch upon your point of US dominancy in the world, I think, you know, the dollar stablecoins really show that the world order is shifting. You know, the place of the US in the world is changing for the good or for the worse, I don't know. And I think the dollarization of the world gives the Trump administration just another tool of basically creating financial colonies throughout the world. And I think, you know, here in the EU, and I'm a proud European, we should be more than aware of this. I think also the supply of stablecoins should be a reflection of like real world economic size. So I think, of course, we should have USD stablecoins in the Eurozone, but we should also have, to a large extent, also euro-denominated stablecoins. So it should be more in balance. So I hope this is a transitional phase that we are seeing today. I'm sure of that. But we need to take more steps to get in a healthy, stable state, if you ask me.
And then what are those steps? So it sounds like we can all agree that it would be great if we could see the proliferation of stablecoins denominated in other currencies than just the dollar. Certainly, I agree with that. Big question is, of course, then how? Turns out it's not very hard. It's not very easy. A lot have tried, right? And many are still trying, particularly in the EU. Do you guys have any views specifically on what needs to happen for these other currencies to be able to compete with the dollar stablecoins?
Well, right now, obviously, and I agree with a lot of what you're saying, I do think, though, that a lot of the impact that the US regulation has had in terms of monetary supply is more symptomatic of, obviously, regulation. It wasn't, you know, the reason why this path, you know, we went down this path to begin with. The US is obviously very complex, you know, multiple states versus federal regulation. Each state operates as its own island. You have, you know, 10 different government agencies that each want to regulate things differently. So I am optimistic that a lot of the regulatory guidelines that have been established, while they will impact both, you know, M1, M2 supply overall and potentially, you know, lead to a more short-term, you know, benefit for, you know, the overall dollar supply and some of our, you know, short-term refinancing needs, I do think it really sets a very strong precedent for how to regulate this in complex environments, you know, like the EU, like certain APAC countries and whatnot as well. In terms of how to get to the point where we do get to, you know, more different denominated stablecoins overall, you alluded to earlier that if you look at, you know, Bitcoin or a lot of these currencies, they are denominated in the US, right? If you look at any order book, if you look at the tape on anything, all depth is based off of US, you know, assets. So generally speaking, when stablecoins are used today, right, you know, it's going to follow where the underlying, you know, demand generation is coming from. And when USDT is used as a conduit, put aside yield for a second, but for trading and speculation, you want the most depth, right? Right now that happens to be USD. But as stablecoins do move to what I was alluding to earlier with respect to actual use cases that banks can adopt, that companies can adopt, that people can really use for actual things, it's naturally going to follow that every nation is going to need and it's going to require its own stablecoin. So I view it as more of a matter of time where it's a little bit of a follow the leader in the sense of how do we adopt and install these regulatory frameworks so that it's easier for a coffee shop to decide that they'll accept or they can settle on stables because they know how it's taxed. It's easier for me to pay my contractors offshore in stables because I know obviously what the, you know, different compliance regulations are going to be, and there's a company that handles it for me, right? And when that happens, then it just becomes natural that obviously as the, you know, euro continues to grow and compound, a stable will follow in similar suit.
Let's hope. All right. Perhaps putting aside the sort of macro and geopolitical questions here a bit, so, and look at the broader space of stablecoins. So it sounds like we all agree also that these will be very interesting assets from a payments and transactional and settlements perspective in the future. I do think there are still quite a way to get there. As mentioned, most activity is still in crypto trading and in DeFi, right? So, Emma, I noticed you had some concerns that the stablecoin market might already be becoming a bit too overcrowded. I think you framed it as such, meaning, I guess, that it's a problem if there are too many stablecoins doing essentially the same thing. Maybe you want to expand a bit on that.
Looking at it purely from a market infrastructure lens, and looking at the benefits of using this technology is to make things faster, more efficient, and less complex. So by the very nature of having more possible payment mechanisms, you're just introducing potentially more avenues of vulnerability that sort of take away some of the efficiencies that this technology offers. So, I don't think that we are, especially within the financial services industry, anywhere close to being able to predict how things might look in 5 to 10 years' time with regards to the use of stablecoins. But I just think that as we go into this, we just need to be very mindful that what we're trying to do is make things, more simple and more efficient and less complex. And so, there's somewhat of a juxtaposition between the two when you just have more and more options.
Indeed. And I can certainly say, as I see it, that the real problem here is that we are facing potential market and liquidity fragmentation. And stablecoins thrive on liquidity, right? That is what you need. And that is actually my answer to the question of why it's hard for other currencies to grow and reach scale. It's because it's hard to build liquidity, in particular when the incumbents in the form of Tether and Circle have so much liquidity already and a global distribution network, right? So how do we avoid falling into this pitfall? I think the market generally agrees there are two ways this can go from here. Either we see a consolidation, so we don't need 100 different dollar stablecoins, we need a couple perhaps, and the same for the other currencies. Or we reach a point where these things are simply so seamlessly interoperable that no one cares what the underlying stablecoin actually is, and all of that complexity will be abstracted away from the actual users. I'm wondering if you guys have any views on sort of which path here is the more realistic one.
So yesterday I spoke in Amsterdam to a bunch of corporate treasurers, and indeed the fragmentation was something that really scared them, because you should not underestimate, because like we are here today in this event, we are all crypto natives, right? So we understand that there's more than one euro stablecoin or more than one USD stablecoin. But these treasurers, they found that really scary. So where do I put my funds? What about legislation? What about privacy? Whatever, all sorts of, complaints and scary stuff for them. So the consensus in that room was that they hoped that in the end, indeed, like you say, Mats, that it will be so interoperable that in the end they will not care or will not even see which stablecoin they're using in the back end. So they might send out a fiat, they might receive a fiat, but what happens in the middle settlement layer, I don't know, they couldn't care less. That was my opinion. So I hope that's the way we're going to go with the industry.
Maybe also building on top of that, it's funny to some extent. I see the point, and it's definitely a point that is important, and also take it important if people are scared. Most of the time, people are scared because they don't know. In the existing banking rails, you have a lot of different private money, and you don't notice. If I send you money via bank wire, I don't send you the same money. I have maybe Deutsche Bank money, you have maybe Citibank money. It's all different money by different issuers, so to say. Nobody notices because it's integrated. Yeah? I think for stablecoins, it will be the same in the future. However, the market will be less crowded, I assume, because it doesn't make sense out of an efficiency case, because it's really an issuer compared to classical banks. Yeah? But indeed, we do have this already, but nobody cares because it's connected already.
All right. So you're leaning towards no consolidation here, but rather interoperability, right? And something that mirrors what we already know from our correspondent banking system today. Fair enough. We have just a few minutes left, guys. Time flies. There's one question left that I would like to bring up, and that is the question of yield. We already talked about it, Shadi. So I guess most of you will know that today, stablecoin issuers, generally speaking, are not allowed to pay out interest. At least that is part of the European regulation. It will also be part of the upcoming Genius regulation in the US. And of course, this is one of the things that will separate stablecoins from money market instruments, right? There's a big question, though, if that might change. And it's one of the biggest topics right now in the sort of ongoing regulatory process in the US regarding the new Clarity Act and whether intermediaries are allowed to pay out incentives, essentially, that are just a sort of roundabout way of paying yield on stablecoins, really. All of this stuff is happening right now, and certainly the American banking lobby is not very keen to see stablecoins become interest-bearing. I'm wondering if you guys think that will we ever get to a point where stablecoins can be truly interest-bearing, and how will that change sort of the dynamics and the purpose and the function they will serve?
We're almost out of time, so I'll be short. I think it's the path is hard. If I'm a regulator, it just doesn't jive with my existing system unless I've completely redesigned everything else. So I do think that by and large there'll be obstacles. There may be backdoors, reward programs, and so forth. But I still struggle to see that happening in the near term. In the long run, I do think eventually these vehicles will be in a world where this is all substitutable and you get the full efficiency effects. But I think that world is a long time away.
Any other takes on that one?
If we could, we would love to pay interest, but we can't. Yeah. It's very simple. And now with both Mica and Genius basically having that framed, I think it's impossible in the next 5 years to change it, to be honest.
And so, Simon, since we cannot pay yield, where does the yield go exactly today?
To the issuers. It's no secret. Yeah, I mean, everybody of us has to earn money. Banks do this the same. They also earn via yield. They also don't pay the same as they earn. I think that's the part of the business. That's fine as long as you provide value. And that's the critical question. And it's just not enough to be an issue and then stop. Yeah, you have to make sure that it's actually integrated. You have to provide infrastructure and foster the infrastructure. And then guess what? For payment mechanisms purely, right now people pay a lot, especially on the merchant side. Yeah? If we only take the yield, they are like, okay, please take my money. I will use you just to save the fees that we have on the payment side.
Thank you. Our time is up. Thank you so much for listening. Please give a round of applause to our panel here.